Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Glad you are joining our program. This is a financial show where we talk about money and retirement and savings and investments and real estate and taxes.
Insurance, mortgages.
Everything related to financial planning. We are financial advisors ourselves, certified financial planner, chartered financial consultants. That's what we do during the week. We air this program on the weekends to be your financial advisors, I guess, virtually. So if you've got advisors you work with today, great. If you don't, regardless, we want you to consider this program another source for information. And by the way, if you want a second opinion on something, if someone's recommending some sort of financial product to you and you're wondering if it's the right thing, feel free to give us a call. I mean, there are so many times we see people make these investment decisions, quote unquote investment decisions, and you look at it down the road and you think, wow, I wish you would have talked to some other professionals because this was not at all normal advice. And you could have really saved yourself from getting involved in something you can never get out of.
Fortunately, most of the times they ask those questions is after the fact when they've already purchased it. And the problem
some
with
non-traded REIT or something they can't get out of, 20-year surrender charge on some annuity or something along those lines.
Yes.
Right? I mean, that's what you see.
It's happened to my own family members. My own family members.
Sold stuff that they...
was inappropriate.
You would think that they would like, that's Pat McClain's family member. Maybe Pat might look over what I'm doing.
I did.
Oh.
I should say they were trying to be sold to my family members.
Okay,
I did.
all right.
It was brought to me, and they said, what do you think? And I said.
So if you'd like a second opinion from us, or if you just have a financial question, we'd love to take your calls. If you've listened to this program for a while, you know that we take quite a few calls, and we enjoy that. And our number to be part of the program is 833-99-WORTH. That's 833-99-WORTH. Numerically, it's 833-999-6784. And if you're a podcast listener listening to this 2 a.m., wherever you are, you can still be part of the program. You just call us and we schedule a time to record your question. Again, it's 833-99-WORTH. And why don't we just start off with some calls here? Let's talk.
Sounds like a plan.
With Vicky. Vicky, you're with Allworth's Money Matters.
Hi. Thank you for taking my call. I have questions mostly about being the executor of a trust that now my parents are in their 90s and they're relying on me to sort of manage things for them. But it's kind of difficult when your parents are at that age where you still kind of see them as able, but they're really not.
Mm-hmm. It is difficult.
And nobody really tells you what to do. I've prepared my own plan, and I have a financial advisor, but I don't really know what to do with their money because I need it to be secure, but at the same time liquid.
And
right?
how many beneficiaries to the estate are there?
There are now 3.
Okay.
And how are they in an assisted living or anything like that at this stage?
Yeah, we've recently had to put them in assisted living because, medicine management and 3 meals a day, all that kind of stuff. They can't cook, it's not a good idea.
And what are the monthly expenses for the assisted living and the other things that go along with that?
So their monthly expenses, so they're making more money retired than they ever did living. And I would say their monthly expenses are no more than $7,000 a month.
And what income sources do they have?
So my dad was a veteran, Korea and Vietnam and U.S. Air Force retired. So he has a pretty good retirement. He was in for over 20 years. They have retirement from the Air Force, Social Security, and also he had 2 annuities that we annuitized when he was in his mid-80s.
And are these lifetime annuities?
So those actually did really well. One is a life annuity.
Uh-huh.
Well, they both actually ended up being a set income for 10 years.
Okay, so they're 10-year annuities. And then
Yeah.
what do you?
They're making. Mm-hmm.
So there's enough money coming in each month to cover their expenses.
Oh, wait,
is that
wait.
right?
So step back for a second. Are they 10-year annuities or 10-year with life certain?
Oh, no, they're going to finish in 10 years.
Okay, so they're just
So if he's 100 years old, he'll be a millionaire. I mean, so I keep giving him living, encouragement to live to be 100, so he can be a millionaire when he's done.
Okay, and then how much do they have in assets?
Basically, they've gotten rid of all their cars. They have very little assets of cash.
Investments. What? How much?
Including
savings,
cash.
investments, whatever.
Everything is pretty much cashed out and coming in, if that's what you're asking.
Yeah,
I'm trying to. Is it at $10,000 or $900,000?
Oh, like about $14,500 a month coming in.
No, yeah, correct. But if
out.
you took everything, so did you sell the house when they went into the assisted living?
Yes.
Okay, so if you took all the money you had in all the accounts, in IRAs, brokerage, annuities that haven't been annuitized, all of those dollars, and you put it in a suitcase, how much money would be in that suitcase?
So everything is just coming in monthly now. They don't have anything else invested, and everything is in like a savings and checking account, which is the reason I'm calling you.
How much money is in savings? Okay, how much money is in savings and checking?
About $350,000 right now.
Okay, and that included the proceeds from the sale of the home.
Correct.
Okay.
Got
all right.
it. All right,
and so your question to us is what? We understand. So they've got.
What do you do to keep up with the rate of inflation?
You don't worry about it.
My question.
You don't worry about it. You don't worry about inflation.
So my advisor told me to put it into like a mutual fund where it earns a little bit more than the savings account. Would that be a correct or safe thing to do?
I don't.
Oh, one question I would have is your father's pension, is there a survivor benefit on that, and what is it? Because some of those older military pensions, oftentimes someone would take a single life on it because the way the beneficiary payouts were structured was not such a great deal. So I'd want to.
And when does that 10-year annuity run out? What age?
And it's not the inflation I'm worried about; it's long-term care.
That's right.
Okay.
For the surviving
it
spouse,
goes from $7,000 a month to $20,000 a month.
Right? Because if your dad predeceases your mom, will that income, is it a single life only annuity pension that he did? Is it a joint and survivor? If it is a joint and survivor, there were many different elections he could take.
It is. There's three. There's my mother would be the first beneficiary, and then if she passes, you know what I mean.
That's on the annuities.
One spouse passes. Then they are each other's beneficiary. But if both of them pass, then it goes on to the kids.
That's the annuities. That's not the pension.
Oh, the pension. I believe it just goes to the parent, mother or father.
Does 100% of it go to the mother?
Yes.
Okay. All right. So you've got a 10-year certain on these annuities. What? When does the 10-year certain run out?
2028.
Okay. So we've got 7 years left.
How much income is coming from those?
A little over 7,000.
Okay.
So that pretty much covers their expenses every month.
That's right.
And then
That's
the rest
right.
is
So,
kind of
but you can think about it.
savings.
If you also think about it this way, I mean, they're essentially spending some of their savings. They just chose to take this, pay it out over 10 years. So they're not living off the interest, right?
They're
took
using
the
a principal.
They gave it to the
No.
insurance company and says, give it back over the next 10 years.
That's what they did.
Yeah,
When they
and-
annuitized.
Which
it.
may have been fine. That's where we are.
So inflation should not be a concern at all, right? Inflation shouldn't be a concern. There will be some inflation between now and then, but that isn't the concern. The concern is there enough money for mom and dad to live comfortably in a skilled nursing facility till their dying day? That's what your concern is. And I don't know why your advisor even introduced inflation.
Well, the inflation is going from assisted living to full-time nursing care.
That's the inflation.
Well, actually, my brother, who likes to dabble in stock markets and so on. And he's really good with money. He used to have a CPA, but now he has a different job, and kind of wants me to invest some of this money so it will actually earn money.
Let me ask you
the rate
this.
of inflation.
Let me ask you this.
But I wouldn't want to lose it all. I feel very uncomfortable with that.
What happens if you took $100,000 and you put it somewhere, and a year from now it's worth $80,000?
Right.
Well, but Scott, why just buy some tips, make everyone happy. It doesn't matter.
Okay.
Seriously. If I had a brother that was saying to me, we should worry about inflation, and I thought it was nothing, I would just pacify them by buying some Treasury protected bonds.
Well, that deals with the inflation, but she's got a brother that thinks that you should put some stocks. If I tell you what,
No, there shouldn't be any stocks.
if these were my parents, I would keep the money in cash.
I'd keep it in the bank. I'd move it to a online bank that paid a little bit higher than the local institution.
We just don't have that much time.
And you have no idea what's in front of you.
And what we do know is in 2028, the income's getting cut in half, and we need liquidity there. That in 7 years is not. I mean, if you go through other market cycles, things might not recover within 7 years.
Your brother's asking you to borrow trouble. Seriously.
Okay. I just needed some
think about this.
reassurance
Think
with
about
that. I feel like I'm doing.
To Pat's point. Think about this. You invest in something. It's a year down the road. It's Thanksgiving or whatever. You're together. The economy's in the tank. The value's down, and now you're having this conversation. Mom and Dad's portfolio is not what we thought it was. Oh, the stock that we thought was such a great thing hasn't worked out.
Yeah. You're managing this not for your brother. You are the trustee. You're managing it for your
100%.
parents, not for your brother.
Okay.
If there are 3 million, not 350, then great.
Have a different story. But there's 350. There's not a lot of room for error here. There's not a lot. And so if you want a little bit higher.
We have longevity in our family. My grandmother lived to 103. So,
That's right.
Yeah.
That's right. That even more reason to keep the dollars in a bank account.
They're in their 90s. They're already in assisted living.
Yeah.
You want to make sure you've got as much liquidity as possible for whatever comes up.
Yeah, and no principal fluctuation. So if you want a little bit higher yield, just go to Marcus by Goldman or go online and look at go to bankrate.com. You're going to get a little bit more. But
what would a good savings account? Is that what you're referring to?
I don't know. What do they make? But 1% or something? Not much.
Not even less than that now.
Yeah, probably 0.5%.
Yeah, the concern is right now you want return of principal more than you want return on principal. You want those dollars secure. Something happens, suddenly mom's needs full-time skilled care, whatever, right? And your expenses suddenly go way up. Mm-hmm. And where are those extra dollars going to come from?
You're the trustee.
Yeah,
there's some medicine that Medicare doesn't cover.
Correct.
All those sort of things.
And vitamins, too. They don't cover vitamins either.
Oh, yes. So. I know that. I'll tell a quick story after this call about vitamins.
Hey,
okay.
Vicky, bless you, by the way, for taking care of your parents. And you're looking at things the right way. You really are.
Appreciate the call.
Yeah.
So after my father passed away, I started getting bills from this company that was delivering vitamins to the nursing home facility that the doctor had prescribed that weren't covered by Medicare. And so
they kept delivering them?
No, they were delivering while he was alive, but he never paid the bill and it wasn't covered by Medicare, but they just kept delivering these vitamins.
Oh, you've got to be kidding me.
And so
over months or years?
Oh, the bill got up to $14,000-$15,000 got in vitamins. Right?
For an old guy in a nursing home.
Right? And so they somehow got a hold of me. And my dad didn't have...
You got to be kidding me.
There wasn't anything in, as many people in America, there wasn't anything much left of my dad's estate when he passed away. And so they got a hold of my...
Try to put a claim on the estate saying they want...
Well, they got a hold of my cell number and they said, we're going to put a claim on the estate. You need to pay this bill for $14,000.
I'm going to report you to elder care.
And I said,
elder abuse.
I said, claim away. Good luck. Have a good time. See what you can get. And they said, well, you owe the money. You're responsible.
You?
Yeah, me personally. And I said, well, explain to me how being my father's son that I'm personally responsible for his debts. And they said, well, you're closing the estate. And I said, okay, why does that make me personally responsible? You could put a claim against the estate. And I said, but go ahead if you want. It won't get paid. I said,
because there's nothing there.
Yeah. I said, it's your business model that actually decided to charge $3 for a vitamin D3, not what it cost in a grocery store or a pharmacy of 3 cents. You were the ones that marked it up. It's your business model to grossly overinflate the price of these vitamins, deliver them to the nursing home.
That's terrible.
For these patients. I said, but look.
And they don't get paid until someone passes on, and then they go after the family or the estate.
Yeah. And I said, look, here's the deal.
Wow.
I'll send you $1,000 out of my own pocket, and we'll just call it a day, and you never call me again. And I said, this is a one-time offer. You get 2 minutes to think about it, and then it will never, ever be offered again. And they said, it's all or nothing. And I said, bad call on your part. You had a chance for $1,000. You get nothing now. They called me for over a year trying to get money out of an estate. And they time and time again kept telling me I was personally responsible. So anytime, this is a warning for anyone, when you were
going to pay the money just so that because you knew that this was going to be a thorn in your side.
Yeah, and it's like, look, but I said to him, it's your business model that you're going to write off so much bad debt. This is one of those. That's 100%. Your model. That's your business
the way
model.
They structure it. It's totally unethical.
But I shared with all my brothers and sisters, anytime my dad went in and out of nursing home, and then you're on, for the first 60 days, it's covered by Medicare, and then you're on your own. Every time that he went to, I instructed everyone in my family, don't sign any paperwork. Do not sign any paperwork on behalf of my dad. I alone will look at the paperwork because oftentimes what they're trying to do is actually get you
financially responsible
for the care that isn't part of the estate. They're trying to get you to go to the second generation, which is me, for financial responsibility. So when she mentioned vitamins, like some of the vitamins aren't covered, that's what it just, these poor people chased me for a year.
Poor people?
Well, that's her job. The person calling me doesn't really, they just need the job. It's the business model, right?
I had a friend when I was a young man, when I was in college, and his parents owned a collection agency, and they did quite well because they had a big house and big cars and all that stuff. Uh-huh. And he worked for him. He would have an alias name, and it was all medical debt.
Oh,
and I remember saying, Dave, how in the world can you do that?
What did he say?
I don't know.
He said, look at my boat. Pass the caviar.
That's bad. That's not even funny. Pass the caviar. No one eats caviar anymore, do they?
I don't know.
Anyway. All right.
I certainly don't.
This is Allworth Money Matters, 833-99-WORTH. We're talking to Edith. Edith, you're with Scott Hansen and Pat McLean.
Yes, I pay for my own vitamins.
Okay, good.
Good
Thank
idea.
You.
Thank you, Edith.
I wanted to ask you particularly about the step up in value that I guess the Congress is tussling with, or is that just a presidential threat?
Yeah, so far there's been that I've seen. There's been no bills that have been written and proposed that deal with this. But this was something that the current administration had stated they wanted as one of their objectives and goals was to reduce the amount that can be of capital gains that can be forgiven at one's death. And the way it currently is structured today is any asset that one owns, when they pass away, their heirs will inherit it with the cost basis, their tax basis, stepped up to the fair market value. So if someone bought a building for $50,000 20 years ago and it's worth $500,000 today, essentially someone who inherits it, it's just like they paid $500,000 for the building, and they could sell it and not pay any capital gain taxes. The administration, what they were proposing is that they would make a limit that up to I believe it was $1 million was the proposal. But the bottom line is there's yet to be any bill out there, legislation that is trying to put this into law at this point. Now,
okay,
if it does happen,
well, if they do have a limit like that, it would be all right. I handle my son's money, so to speak, his investments. He does the mechanics of it, and I do the investing. And he will, when I pass, he will receive the home, which will be sold immediately. And I'm concerned about the step up in basis, because he and I have purchased a condo, which is a rental right now, but he will move into that when the house is sold, and he will move into the condo, and the mortgage, which is right now about $260,000, will be paid out of the proceeds of the home sale. Do you follow?
Yeah.
So I'm concerned as to whether he's going to. We did get a step up in value in 2009 when my husband passed away. So, and I'm wondering if you say if they do $1 million forgive on that, why it would be covered. The house, according to Zillow, is $1 million.
I'm sorry, we lost you there. $1 million.
$1 million plus.
Okay, so
according to Zillow.
Now, so Edith, let's think about this, right? So Scott mentioned the $1 million, but that $1 million may not apply to a home. It might just
right now it's all conjecture.
Yeah, so we could worry about it if you want.
Oh no, I don't want to worry. I just wonder what the ramifications would be if they do it.
So I doubt
we don't know what they're going to do yet.
But quite frankly, I doubt it would affect you whatsoever.
Okay.
They're talking about a primary residence.
And it's really targeted. Here's where it's targeted. And it might be directly right at Donald Trump, frankly. It's oftentimes people in the real estate business, they're able to transfer, they have a piece of property, goes up in value, they do some improvements on it, whatever, goes up in value. They sell it and they buy something similar, like kind, and they can transfer their cost basis over. It's a tax-free exchange, and so they exchange it and they exchange it and they exchange it, and then they've got all these dollars in real estate, and they just take loan out and they live off the proceeds of the loan, so they never pay taxes. We see the same thing can happen in stocks as well. And then when they pass on, all that capital gain is forgiven because of the step up in basis.
And they take the proceeds from the estate and pay off the loans, and therefore they've been able to live off an asset and income from the asset in the form of loans without ever paying taxes on it.
That's the target. Whether you like it or not, that is what the target.
And we talked about it a couple weeks ago on our show about how people use, very wealthy people, the Elon Musk of the world, the Bill Gates of the world, use their investment portfolios and they take loans against them in order to minimize their tax. And under current law, that step up in basis essentially allows this money that they've lived on for years and years to never be taxed at all. So it's not aimed at Edith, who lives in small town America, who, isn't a fat cat. It's aimed at people. Well, my guess is that it probably won't. There'll be a limit. It might be $1 million, but it might be a net worth limit as well. But it certainly isn't targeted. No Democrat or Republican back in Washington is taking aim at Edith and Edith's son.
I wouldn't worry about that. I really wouldn't worry. And furthermore, there's no legislation out there now to even say we don't like it.
And if it does change, it will change how good financial advisors manage people's portfolios. Because we, as financial advisors managing over $12 billion, recognize the current rules in which we live and the step up in basis. And we will hold on to things that you might not otherwise buy today just because of the tax ramifications of actually changing those holdings in a portfolio.
Yeah, particularly as someone gets older.
Yeah. So, Edith, you're okay.
Yeah, I wouldn't worry about it now. I wouldn't worry about it at all.
Yeah.
I really wouldn't. I mean, pay attention to what happens with tax changes. It has to become law, though. I mean,
and even if there was...
Congress, both houses have to agree upon it.
And you had to step up in basis in, what'd you say, 2009. So
even
then, you don't have $1 million plus gain in your house. That's
no.
Yeah, you're fine, Edith. Go out and enjoy the weather.
Thank you very much.
All right, appreciate the call.
I've been your fan since the first program you were on, in I don't know what year it was, many years ago.
1995.
No, but
Is that when you started?
No, you're out of, but
program.
you're out of Denver. So you listen to us on KOA in Denver. So
No, I'm in Sacramento.
Oh, you are in Sacramento. Oh, yeah. How long have we been doing this?
1995. We started on Talk 650 originally. It was 1990. It was middle of 1995.
Oh, well, thanks for listening, Edith.
Yeah, we appreciate it. And hopefully she's going to listen for another 26 years.
Has it been 26 years?
Yeah, that's a long time. Anyway, we're going to take a break. We'll come back in just a moment, and we'll continue on with calls. If you want to join us, 833-99-WORTH is the number to be part of the program. And stick around for more Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
And let's jump right back into the calls. We're in Denver talking with Brian. Brian, you're with Allworth's Money Matters.
Hey, guys. Thanks for having me. How are you?
We're
guess
good.
This afternoon.
Really good.
Hey, I've got a question about an offer in compromise, if you guys can kind of help steer me or give me some options.
Right.
Just before you ask the question, I'm going to tell you we're going to give you limited advice.
Right. I'm not looking for legal advice.
Okay. That was Pat's point. And it's amazing the things that attorneys will say are that's legal advice. Because they've told me, Scott, oftentimes you're writing legal advice and you're not an attorney. I'm like, oh, well, that's your opinion.
Right. Well, you give financial advice and you're not a financial advisor, Mr. Attorney. But so what's your question for us?
All right, guys. So basically, it's pretty simple. I'm shopping around. I owe a lot of money in back tax from actually about 10 years ago. And it's all finally come to surface, okay? And I went onto the website. It basically says that they give you like a little tool that says, whether you would qualify or you don't qualify for something of that sort. In my instance, it's pretty much saying, hey, you won't qualify. So what I'm looking at is, one, still trying to make that happen.
Are you represented by somebody?
No, in fact, that's just it. Is it for me to do that and try to submit one of these, it's going to cost me another $8,000 to $10,000 in my area.
How much do you owe to the IRS?
About $100,000, and that's without fees and all that.
And that's just a pure tax. That's without any of the compounding that took place on it. So the pure tax.
At some point,
obligation
right,
was
I was in
$100,000
business for myself at some point and went through a fantastic divorce, and now I don't have any of that type of income anymore.
Any of these payroll taxes?
No.
None of it's payroll. It's all income taxes. You're 100% sure that all the payroll taxes have been paid for you and your employees.
Well, I would have to say that yes, it's mine as well because I was the one that incurred the tax.
But it's not payroll taxes.
No, and it wouldn't be payroll.
Okay, it's not Social Security withholding for you or your employees. That's key. Okay, so it's $100,000 without interest or penalties on there. What is your income today?
About $80,000.
And what other assets do you have?
Nothing really in my name. I've got a vehicle. That's about it.
Okay.
That's what I have in my name.
Now, so you use the term "in my name." What does that mean? Is there assets that you have in someone else's name, or?
No, I don't have that, but I share expenses with others that the home that I'm in, for instance, is not in my name.
Do you own
my partner?
Okay.
Go ahead.
Are you on?
But my partner does.
Okay. And when you bought this home with your partner, did you come up with any portion of the down payment for the home?
No.
Okay. All right. So just be careful when you use the word "in my name."
Have they? Yeah, don't mention that to the IRS.
Right.
Have you been in conversation? Have they presented any sort of offer?
Yeah. So basically, I haven't extended an offer yet. But what's happened is, I had everything filed and completed. There was some mishaps with somebody stealing my identity and filing for certain things that I've never filed on. So we had to go through a bunch of hoopla to get here. But now I'm finally here, and I'm finally starting to get letters back saying, "Hey, okay. They accept this or whatever."
And what are they offering?
They're not offering. They're just sending me a bill.
And how big's the bill they're sending you?
That's where I'm at. For the 1 year, it's only been a little over $5,000. But I know from what I've filed what I'm supposed to owe.
Do you have a CPA? Not one of these firms that advertises and offer a compromise. Go and you said it's going to cost $8,000. Just go and visit with a decent CPA firm. A mid-sized.
Okay. You want to talk to someone who's a tax professional, not just a.
Not someone that just does offers and compromise. Because this is what's going to happen. You don't have to go to a Deloitte or KPMG, but you probably shouldn't go to a one-person office either. Although there's many good one-person offices, but you want kind of a little broader view of the firm, maybe 4, 5, 6 accountants in there. And they're everywhere. Go and visit with one of their people. Explain your situation, and then say, how do you think I should deal with this?
Agreed.
And this is what they're going to tell you. They're going to do one of two things. They're going to say, okay, we'll do it for you, and this is what it's going to cost, and this is probably what the outcome is going to be. Or they're going to refer you over to a reputable firm that deals with nothing but offers and compromise, or deals with a large portion of their business as an offer and compromise. But that's where, if you were my brother, I would say start with a medium-sized accounting firm that does tax preparation and tax planning and have the conversation. I wouldn't immediately go to the infomercial guy, but I would go to a qualified. And it will cost you a few $1,000s, but they'll be able to tell you what it's going to cost at the very beginning. It doesn't sound like you're going to be able to do it alone, though.
Okay, and I appreciate that. I mean, I just knew that, there's equity in the home that we're in that we could probably use, which I don't know if
it's not yours.
Right. Well,
you just told me that.
I understand that.
That's not yours.
That's good.
So don't ever say there's equity in the home that
come up with a loan. For
well, maybe that might be part of the offer and compromise is a loan, but you don't own that home. You told me you didn't own that.
They might reduce the amount down and they give you a number of years to pay it off.
Yeah, but you don't own that home.
Right.
So don't offer, you can't pledge someone else's equity. In fact, what you just did makes me think that you actually have beneficial interest in the equity in the home.
See, and that's what I was saying. That's what I'm afraid of.
Yeah, you should be afraid of. You should be afraid of. The IRS is used to people hiding stuff from them.
You think?
Oh, yeah. Yeah.
All right.
Absolutely.
All right.
I appreciate
the
show.
Well,
you better deal with it now because it's not going to go away on its own.
It's not going to go away.
Oh, no. And that's what I've been trying to do. And all that's.
It's been 10 years.
I'm trying to just. Yeah. It's been a long time.
Yeah. So if you were my brother, as Pat just said, I would say get this taken care of now. Because otherwise, it's going to be 5 more years from now, and you're still got the problem.
And if you were my brother, I would say, don't come to me looking for a loan. That's only if you were my brother.
I'm not going to comment on anything in my current family situation. So
every family's got its own dynamic. I went on vacation with my family last week. My 4 kids, age 20 to 25. We went to Alaska last week, and my wife and I and our 4 kids, and we had a marvelous time. We just had probably one of the best vacations I can remember.
What are your ages of your kids now?
20, 22, 24, and 25. And they're all out of the house. My daughter actually moved back in after getting her master's degree in education and teaching, but I love having her around the house. I love all my kids. I especially love having her around the house.
Just to clarify.
I love all my children, if they ever were by chance to listen to this podcast. But we had a marvelous time, and Alaska was busy.
Oh, really?
Busy.
Because it's all part of the U.S. and because the foreign tourists.
That's what I asked why, and they said it isn't the number of people, that it is labor, absolute labor.
What's labor?
Not enough labor.
Oh yeah, that's any vacation spot.
Yeah, not enough labor.
It's a tremendous problem.
Yeah.
A lot of these restaurants, they only have 2/3. You're like, how come I can't get in? It doesn't even look crowded. Like, well, we don't have enough. We don't have the cooks. We don't have the bus boys. We don't have the waiters.
Yes.
And it's it's a
tough thing.
Yeah.
You know, Scott, I wanted to actually talk a little bit about this. We talked about these SPACs, special purpose acquisition companies. We talked about it a couple months ago, if I recall, when they first started. A number of months ago, when they first started getting hot, where these things were absolutely ripe for
fraud,
right? Absolutely right. We said, this is how these SPACs work. A group of it.
And a SPAC it's essentially a way. It's essentially a way for a company to go public, without having to really go public, and right.
And they call them blank check companies. So here's how a SPAC would work: a group of business people can get together, and they could say, we're going to open up this company called a special purpose acquisition company, and we're going to underwrite this, which means they are out of their pocket going to pay for the cost associated with the incorporation of the company and raising the money. It's not an easy feat. You've got to have some specialty there. So they go out and they say, we're going to put in $10 million, but we're going to raise, let's say, $500 million. And we're going to raise this. And when we raise this money, we're not going to tell the investors what we're going to do with the money. We're just going to say, look, this is who we are. We're business people. Trust us. We will go out and find a good company.
What could go wrong?
Right? What could go wrong? Oh, and by the way, we're going to invest the $10 million for the incorporation of this company, but we're going to write this in such a manner that we're going to end up owning 20, 30, 40% of the new company. And, oh, by the way, we're going to pay ourselves a bunch of fees for doing this, including reimbursing our $10 million.
The promotion fees.
The promotion. Actually, I talked to a private equity guy, and he was telling me how he had just done one. He said, we crushed it. He didn't say the investors crushed it. He said, we crushed it. So this is the first example I have seen where exactly what Scott and I had talked about 6 months ago, 9 months ago, whenever it did, how ripe for fraud they are. New York Times, July 30th, SPACs on trial. Special purpose acquisition companies on trial. Charges against founder of Nikola cast a shadow over the blank check. Boom. What'd you say earlier? What could go wrong?
What could go wrong?
What could go wrong? I'm going to give some money to someone.
Nikola, isn't it their the e-company, right?
They're the
electric trucks.
Electric trucks. So
we need electric trucks, Pat.
In their promotion.
Sounds perfect.
So they're being charged. Nikola went public in June last year by merging with a blank check firm, Vector IQ. And Vector IQ was founded by a former General Motors executive. So it's got all the bona fides, right? It's a GM executive. We gave it a fancy name like Vector IQ. This gentleman, Milton, according to the U.S. Attorney's Office in Manhattan, said they have defrauded the investors. You're like, how could they defraud the investors? Well, this is the best part. They actually showed a picture of the truck driving down the road, a video of it. It sounds great. They omitted the fact the truck was rolling down an incline due to gravity rather than under its own power. So for the promotional video.
So they make it look like the truck's operational. Check it out. We have the trucks, they're built. Look at it go down the highway.
Right.
That's great.
That is like me riding my bike and going down a steep hill and bragging about how fast I am. I'm fast for that little period of time on the steep hill on my bicycle. The rest of the time, I am slow.
How in the world can they think that first of all, that they can get away with that.
I know. No. Isn't this awful? And think of all the investors that put money into these special purpose acquisition companies. So, what's going to be the outcome of this is regulation. And we see this stuff pop up time and time again. We see it in the cryptocurrencies, non-fungible tokens. Is that what they're called? Non-fungible?
Yeah. NFTs.
NFTs. Non-fungible tokens. We see this in SPACs. It takes regulators a little while to chase down.
To catch up, figure out what's going on.
To catch up on these things. And in the meantime, while the regulators are trying to catch up, people lose not millions, but truly billions and billions of dollars. And when this SPAC fund started, this craze started about a year and a half ago, you and I both said, this is just a reallocation of
transfer of wealth
from people's who aren't in the know to people who are in the know net worth. Watch, there'll be more to come.
And it's not to say that they're all bad.
They're not all bad. They're just not regulated.
The same way a public company is.
Yeah. They are public companies, but they just get through this little loophole.
Yes.
So
they drove a truck through the loophole. Didn't drove a truck. They allowed it to roll downhill.
That's actually a pretty good analogy. They drove a truck.
All right, let's head back to the calls. All our contact numbers 833-99-WORTH. We're talking with Gretchen. Gretchen, you're with Allworth Money Matters.
Well, hi. Thank you so much for taking my call.
Yes, thank
I really
you.
appreciate it. So, in my short question is, I've got a question about where to park about $500,000 of cash until the stock market crashes. So, the longer thing is that I have about $2.5 million in my traditional IRA, and I got scared over this past year because I had profited so much from the rising stock market, especially the NASDAQ, where I had a lot of investment in tech stocks. Almost all my investments in my IRA are in individual stocks. So I decided rather than being greedy, I should take some of those profits while they seemed to me overvalued or just had risen so high. And so now I've accumulated like $500,000 in cash, and it's earning like nothing in my account.
So Gretchen, this is in your IRA. So this is what I just heard from you. I have a highly concentrated position in technology stocks in my IRA. Excuse me. 80% of my portfolio is in this highly concentrated technology NASDAQ sector, and 20% is in cash, which gives me an 80-20 portfolio. Is that what you said?
Well, you're saying no, it's not high. It's not too highly concentrated in tech. It was the tech stocks that
sold.
seemed rather explosive that I sold.
Okay, and so the $2 million that's still in stock. How is that invested? Is that all in stock?
I have some in just dividends, stocks. It just not necessarily tech.
Okay, and how long have you had a portfolio like this?
That IRA has been accumulating for maybe 30 years.
And how long have you held it in?
I also have a Roth IRA.
How long have you held this IRA in individual stocks like this, or is this new?
I'd say that's about 10 years.
Okay. And how old are you?
I'm 62.
And are you retired?
I just retired.
Oh, congrats. How did you manage the portfolio during the financial crisis?
I just held on to things, and I just held. I'm usually just hold for the long term. I'm not someone who usually buys and sells, but it might have been prudent.
You're like an individual. I mean, I'm a believer in like the stock market for the long term, but when you're starting investing in individual companies, there are clearly times to sell and clearly times to buy.
So there is given, by the way, you doing what you did, regardless of market conditions, was probably a very responsible thing to do. And whether the market was up and or down or flat, because you went into retirement.
Yeah, and you sold some of the ones that had the run up in value. Oftentimes people sell the losers.
Yeah, and so
what they think losers. They might be great companies, but the price hasn't moved much.
Mm-hmm.
I would make the argument that your portfolio, and are you living off a pension? What are you living on in retirement? Income?
No, right now I'm living off of some savings. I just had put some money in a long-term, like a high-interest savings account.
When that money's gone, what will you be living off of?
I'm not really sure. I'm going to sell stock or live off of dividends. That's
okay.
I'm looking at that now.
How much money do you have in savings?
So just probably another $70,000.
And what was your income when you were working?
About $100,000 when I stopped.
And do you own a home?
Yes, I own a home and 2 rental properties. I have about $1 million in equity in real estate.
Do you owe money on any of that?
Yeah, well, I have in real estate I probably have $1.2 million.
What do you owe on that
value,
real estate?
But I only owe like $200,000.
Okay, so here's look. You are the poster child for Roth conversions right now.
This
right now. So
you have essentially no income.
Yeah, correct. You called asking about what to do with $500,000, and I went 180 degrees in a different direction. Right? That is a question that we will answer. But what you should be doing is, first of all, determining. I would make a premise that you should start IRA distributions almost immediately. And if you don't start IRA distributions, then you should actually start converting your Roth IRA to Roth IRAs. My guess is you'll probably be better off doing a combination of both those things. I would not be living off those savings and waiting until that is all used up before I dig into the Roth. And I would certainly consider Social Security at this point in time, but I'm not certain. That would take some planning.
Yeah, and I mean, this IRA, you've done a good job saving, obviously, over the years. The purpose of it now is to provide an income for you, right?
Yes. Uh-huh.
Yeah. So,
and I also have a Roth IRA.
How much is in the Roth IRA?
Account. So the Roth is about $400,000, and my brokerage is about $350,000.
Okay.
Oh, okay.
So you should. Look. In your brokerage account, do you have any cash equivalents or short-term bonds in there?
No.
None. It's all equity.
Oh my gosh. You are very aggressive.
Holy smokes.
Yes.
You are phenomenally aggressive. You, Gretchen, remember, you're going to react differently in retirement to your portfolio than you were when there was income coming in. That's just a fact. Fact. We've worked with thousands and thousands of clients, and how they react to market turbulence when they're retired is much different than when they were working. You've got a number of different things that you should be doing in your portfolio right now. I would make the argument that maybe we should be liquidating some of the brokerage account and paying off the debt on your real estate completely and using 100% of that real estate income on the rental properties to live on. I'd also make the argument that it may make sense for you to take Social Security. And I would make the argument that you should start an IRA distribution as well as Roth conversions all simultaneously.
Wait, what money are you saying to pay off my mortgage?
Your brokerage account.
Oh.
Possibly. Depends on what kind of
tax
situation there is.
So
I've been taking money.
Well, you've been taking money from the brokerage account?
From the brokerage when I have inflated, and I've been donating money to charity.
Even better.
And are you donating cash or are you donating appreciated stock to charity?
No, the appreciated stock.
Perfect. Perfect.
You would benefit from sitting down with a qualified financial advisor and doing some financial planning here. I mean, you're like poster child for it.
I would not take that $500,000 and put it back into equities.
No.
Would not. Would I put it into an alternative? Yes, I would probably consider something other than equities in that IRA, but I would not have any designs ever in the future to reinvest those dollars into equities based upon the fact that you're retired and the fact that you're
going to need some income from this.
You are highly, highly overweighted in equities unless you have an incredible risk tolerance.
Yeah, but even still, it's about timeline. So you're going to need some of these dollars to live off. So you don't want 100% in stocks at this point in time. But
you would benefit from sitting down with a qualified advisor and paying them for a financial plan.
Yeah. And appreciate the call, Gretchen. Let's talk with Matthew. Matthew, you're with Allworth Money Matters.
Hi. Thanks for taking my call.
Yeah. We're a little tight on time, so what's the question here for us?
So I am a recent graduate of the University of Colorado, and I went through the personal financial planning program. I'm actually scheduled to take my certified financial planning certification in November. And I really appreciate what you guys do. I think it's awesome. My question is, so when I put together mock portfolios for school, and I've done that a couple times, and I kind of work with my parents doing that a little bit, I always kind of find it hard to understand the difference between when you would want to use a mutual fund versus when you would want to have an ETF. Because to me, it seems that ETFs oftentimes have lower expense ratios and are easier to kind of move money around if you need to.
I mean,
the expense ratios on if we're talking about passive, the expense ratios have dropped significantly over the last 12 to 24 months, so that there's oftentimes we use them interchangeably depending upon what's less expensive.
It used to be there would be trading costs on ETFs and not on mutual funds, but now, because most firms have eliminated trading commissions, that's kind of irrelevant.
Yeah. But I do want to say this: if you're graduating, we're always looking for good people. Go to our website, allworthfinancial.com. We may be looking for people in our Denver.
You're not going to be working with
No. Yeah.
Anyway, we're out of time. It's been great having everyone with us. We'll see you next week. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.